A company headline hits your phone before the market opens. You have 30 seconds to decide whether it is good, bad, or meaningless for the stock. Would you trust ChatGPT with real money?
I would trust it to summarize the headline, maybe. But predicting what thousands of traders will do next sounds like fortune-telling.
That is the assumption this study challenges. The model was not asked for a target price or a year-end forecast. It was asked a narrower question. What does this specific headline imply for this specific company in the short term?
So it is less name tomorrow's winner and more understand the economic meaning before the market fully digests it.
Exactly. The paper is called "Can ChatGPT Forecast Stock Price Movements? Return Predictability and Large Language Models."
And did the answer turn out to be yes?
Partly, and that word matters. GPT-4 aligned strikingly well with the market's immediate reaction. Its scores also predicted a smaller price drift over the next 1 to 2 trading days.
That sounds like an easy trading system.
Not so fast. The biggest reaction often occurred before an ordinary investor could act, and the later opportunity was vulnerable to trading costs and short-selling constraints. The real surprise is not that AI printed free money. It is that a general language model extracted economic meaning from headlines that prices sometimes absorbed only gradually. The research problem begins with a basic idea from finance. Once public news appears, prices should incorporate it quickly.
But a headline can be grammatically positive and economically negative, depending on the company.
Precisely. Consider the paper's example. Cigna calls off Humana pursuit, plans big stock buyback. A conventional data vendor score treated the headline as positive for Humana, assigning 0.65.
I can see why. Big stock buyback sounds bullish.
But the buyback concerned Cigna. For Humana, GPT-4 answered no, and reasoned that the abandoned pursuit removed a potential acquisition premium. The same words carried different implications for the two firms.
So a keyword counter may notice buyback, while a contextual reader asks, who gains, who loses, and why?
That distinction creates two research questions. First, can an LLM identify the direction of the market's initial response to company news? Second, after that first response, do prices keep moving in the direction the model indicated?
The first question tests interpretation. The second tests whether interpretation arrives before the market has finished adjusting.
Correct. The authors also asked whether older or smaller language models could do the same job. If every text model worked equally well, the result might be ordinary sentiment tagging. If only more capable models succeeded, that would suggest the task requires contextual reasoning rather than simply counting positive and negative words. The authors assembled 159,137 firm headline date observations covering 4,123 U.S. companies from October 2021 through May 2024.
How did they reduce the risk that GPT-4 had already seen the answers during training?
They used a fixed GPT-4 snapshot, whose training data stopped in September 2021. So the tested headlines came after its stated knowledge cutoff. They matched those headlines with daily returns from CRSP and intraday trade data from TAC.
What did they ask the model?
For each company and headline, GPT-4 answered yes if the news was good for the stock, no if it was bad, or unknown if uncertain, followed by one concise reason. The temperature was set to 0 for reproducibility, and the answers became scores of 1, -1, or 0.
Then they compared those scores with what prices did?
Yes, but they separated two moments. For overnight news, the initial reaction ran from the previous close to the next opening. For intraday news, it ran to 15 minutes after publication. Then they measured the later drift that a trader could attempt to capture after the announcement.
Why separate overnight and intraday news?
Because timing determines what is realistically tradable. About 82% of the timed headlines were overnight. The researchers formed daily portfolios that bought stocks with positive scores and shorted stocks with negative scores. They also ran regressions with firm and date controls, then compared GPT-4 with vendor sentiment, Finbert, and language models of different complexity. The clearest result was GPT-4's alignment with the initial market reaction. After positive overnight news, the average opening reaction was 1.27%. After negative overnight news, it was negative 1.79%.
And during the trading day?
For intraday headlines, the initial reactions averaged 1.33% for positive scores and negative 3.11% for negative scores.
Those are large moves. Was GPT-4 right about 90% of individual headlines?
No. The paper reports portfolio day hit rates. The net long-short portfolio moved in the predicted direction on 93.3% of overnight news days and 88.8% of intraday news days. That is not headline-level accuracy, and much of the initial reaction was already in the price before a normal post-news trade.
What remained after the market opened or after the first 15 minutes?
A smaller but statistically significant drift. The overnight long-short strategy averaged 0.34% on the first trading day after the news and 0.19% on the following day, with no significant continuation afterward. The effect was stronger after negative news and among smaller stocks.
Did model sophistication matter?
Generally, yes. Basic models such as GPT-1, GPT-2, and BERT did not show the same forecasting ability, while more advanced models performed better, with GPT-4 strongest in the paper's comparisons.
So it was not predicting from charts or secret data.
Right. It extracted a directional economic judgment from public text, and the researchers tested whether prices agreed immediately and continued adjusting afterward. The dangerous takeaway would be paste a headline into ChatGPT and buy whatever it says.
Because the experiment used a systematic portfolio, not a casual chat about one stock.
Exactly. It rebalanced daily, bought many positively scored stocks, shorted negatively scored stocks, and depended on low implementation costs. The baseline overnight strategy had about 190% daily turnover. With a 0.20% round-trip transaction cost, it became unprofitable in the paper's test.
So the striking back test was not a promise available to every investor.
No, the strongest practical lesson is about information processing, not a guaranteed trading recipe. An LLM can serve as a disciplined second reader, identify the affected company, state the likely economic channel, separate immediate impact from longer-term value, and admit unknown when a headline is insufficient.
Do not ask only, does this sound positive? Ask, positive for whom? Through what mechanism? And has the price already reacted?
There is also a built-in paradox. The paper's model predicts that if many investors adopt similarly capable LLMs, their trades should push information into prices faster, shrinking the predictability they hoped to exploit.
Did the data show that happening?
Strategy performance declined over the sample as LLM adoption rose. That is consistent with improving market efficiency, although it does not prove AI caused the decline.
So the lasting insight is not that ChatGPT knows the future.
It is that language understanding can become economically valuable when markets process complex public information unevenly. The harder question is whether anyone can act before the same interpretation reaches everyone else, and whether any remaining edge survives the real cost of trading.